So this is a tab in the business Ultimate Business Tools spreadsheet that talks about your balance sheet and how cash can sometimes be hiding in your balance sheet. So let's go through and have a look at some numbers, and you've got access to this, and we're only going to enter data in the blue cell. So there's some data in here already, similar to what we've done on a lot of other P&L. So we're going to look at this business for 365 days, and it has sales for that period of 500, 250 COGS, 200 fixed expenses. Now, we're not really interested in profit at this point. We use these figures to calculate a few variables below. Now, if over that 12-month period, we average month by month $25,000 in inventory, and we can do this by running a balance sheet month by month and averaging it out, each of these ones in that context. And we had for average receivables or debtors, people who have a debt to us is a good way to receive it, and that was 50. And our average for payables or creditors, people who have a credit to us, is 15. So that's our base case. And as I said, I've worked out averages for a year. You could do it for a quarter if you wanted as well, a smaller period. You just adjust the values here. So the way this rolls is illustrated by this picture here. So on day one, we get inventory into our business, and then we have so many days to turn it into something we can build. Now, obviously, if you don't have inventory or make stuff in your business, it's not relevant. Usually when the inventory arrives, we'll get an invoice, and we will have usually 30 days, and this down here is the bottom, is the number of days, 30 days to pay for that, okay? Now, here's a challenge though. If we're taking longer than 30 days to produce something, say in this instance it's taking us 50 days on average to produce something we can sell, we sell it. And then it's taking another 30 days until we're getting the money in. It's taking us up to 90 days for the cycle to go around. The cash conversion cycle is the time it takes from when we pay money out to when we get the money in. That's the cash conversion cycle. So if we look down here, it does all of these calculations automatically for us. So in this instance here, with these figures in the blue, if we have 37 days of inventory, and our receivables have been 37 days on average. Don't worry too much about how it's doing the calculations, just know that it's happening in the background. And then on average, we're paying our bills every 22 days. That means we've got a cash gap of 51 days. Well, we've paid out money, but we haven't got money back in for what we've sold. Now, in this instance, the cash that we need in here to keep the business running is $28,000. So what if we were to reduce our inventory days? So here's an example here. So at the moment they're 37 and we got it down to 35. So we improved our efficiency. We got our debtors to pay us quickly. We went from 37 and we got it down to 32. Again, these are numbers in blue. And what if we stretched out the time we're taking to pay our bills out to 30? Now the cash gap has shortened, and you can see up here it does it automatically. We're now down to 37 days. Now we've only got to cover $20,000 in this period here, and which means we have $7,700 extra cash available. So what if we sped it up even more? Let's say we got our inventory days down to 30. Now you see how it all changed shape there. What if we got our receivable days down to 25? You'll see it changes shape again. And increase our payable, we don't want to go more than 30 days. That's not very nice. Now our cash gap days is 25, so we've effectively halved it. So we need less cash to cover the running costs of the business, and we have more cash available. So that's how we use the Find Your Cash tool when it comes to your balance sheet. Have a play with your business numbers, download your balance sheets and put some figures in and see how you go.